Preparing for a financial analyst at Best Buy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Best Buy? Best Buy interests me because it operates in a competitive, fast-changing category where finance directly influences customer experience and profitability. I would enjoy analyzing sales trends, product margins, inventory levels, labor costs, and online versus store performance to support practical decisions. The company's omni-channel model also creates meaningful analytical questions around fulfillment and customer behavior. I bring strong Excel skills, attention to detail, and a business partner mindset, and I want to turn data into recommendations leaders can act on. While answering, connect your analytical skills to Best Buy's retail model, customer focus, technology products, omni-channel strategy, and the opportunity to support decisions involving sales, margins, inventory, expenses, and long-term profitability. Question 2. What do you know about Best Buy's business model? Best Buy sells consumer electronics, appliances, computing products, entertainment products, and related services through stores and digital channels. Its economics depend on driving customer traffic, converting demand, managing product margins, and turning inventory efficiently. Services, memberships, installation, and warranties can add recurring or higher margin revenue. Vendor partnerships and omni-channel fulfillment are also important because customers expect competitive prices and convenient delivery or pickup. For an analyst, that means evaluating growth together with margin, inventory, and customer experience trade-offs. Make sure to cover Best Buy's consumer electronics retailing, stores and digital channels, product and service revenue, vendor relationships, competitive pricing, fulfillment capabilities, and the importance of inventory productivity and gross margin management. Question 3. Walk me through how you would build a sales forecast for a Best Buy category. I would begin with historical sales by category, channel, location, and week, then identify seasonality and unusual periods. Next, I would incorporate promotional events, product launches, vendor constraints, pricing changes, macroeconomic assumptions, and expected shifts between stores and digital channels. I would build base, upside, and downside cases, document the assumptions, and review the forecast with merchandising and operations partners. Afterward, I would compare actual results with forecast, explain variances, and update the model using current evidence. In your answer, talk about historical trends, seasonality, promotional calendars, product launches, channel mix, store performance, macroeconomic assumptions, management input, scenario analysis, and variance review against actual results. Question 4. How would you analyze a decline in Best Buy's comparable sales? I would first confirm the comparable store definition and isolate the period, category, and channel affected. Then I would decompose sales into traffic, conversion, average transaction value, units, pricing, and mix. I would also test whether stockouts, weaker promotions, competitor pricing, product cycle timing, or regional conditions explain the decline. Finally, I would compare results with budget and prior year, quantify each driver, and recommend actions such as improving availability, adjusting promotions, or reallocating marketing support. Be sure to mention decomposing traffic, conversion, average transaction value, units, pricing, category mix, channel, geography, promotions, inventory availability, and competitor activity before recommending corrective actions. Question 5. What financial metrics would you monitor for Best Buy? I would monitor comparable sales, total revenue, gross margin rate, operating expenses as a percentage of sales, operating income, and earnings conversion. For retail execution, I would track traffic, conversion, average transaction value, inventory turns, stockouts, shrink, and digital penetration. Cash metrics matter too, including working capital and free cash flow. I would not view any metric in isolation. For example, sales growth accompanied by heavy discounting or slower inventory turns may weaken overall economic performance. Focus on revenue growth, comparable sales, gross margin, operating expense rate, operating income, inventory turns, free cash flow, digital penetration, services performance, conversion, average transaction value, and return on invested capital. Question 6. Explain the difference between gross margin and markup, using a retail example. Gross margin is gross profit divided by sales, while markup is gross profit divided by cost. If Best Buy sells a product for $500 and pays the vendor $400, gross profit is $100. Gross margin is 20%, calculated as $100 divided by $500, while markup is 25%, calculated as $100 divided by $400. The distinction matters because margin measures profit relative to revenue, which is generally the more useful basis for comparing categories and evaluating financial performance. While answering, define both measures clearly, show the formulas, use a simple Best Buy product example, and explain why gross margin is more useful for comparing profitability against sales. Question 7. How would you evaluate the profitability of a promotional event? I would compare actual performance with a well-supported no-promotion baseline, not simply measure total sales. The analysis would include incremental units, selling price, product gross margin, vendor funding, markdown expense, fulfillment costs, labor, returns, and any cannibalization of other products or future demand. I would also consider inventory reduction and customer acquisition value. The final recommendation should assess incremental contribution profit and cash impact, because a sales lift is not attractive if the event destroys economic value. Make sure to cover incremental sales, cannibalization, discount cost, product margin, vendor funding, fulfillment and labor expenses, inventory benefits, customer acquisition, and post-promotion profitability. Question 8. What is working capital, and why is it important in retail? Working capital reflects the funds tied up in operating assets and liabilities, commonly receivables, inventory, and payables. In retail, inventory is usually the largest driver, so purchasing too much can create markdowns and cash pressure, while purchasing too little can cause lost sales. Supplier payment terms also affect liquidity. I would monitor inventory days, turns, payable timing, and seasonal changes, then connect movements to free cash flow. Strong working capital management supports both availability and financial flexibility. In your answer, explain accounts receivable, inventory, accounts payable, cash conversion, seasonal purchasing, stock availability, supplier terms, and how working capital affects liquidity and free cash flow. Question 9. How would you investigate an unfavorable inventory variance? I would first determine whether the variance is a quantity, price, timing, or valuation issue. I would reconcile the general ledger to inventory subledgers and review purchase receipts, transfers, sales, returns, cycle counts, and cutoff around the reporting date. I would investigate shrink, damaged goods, obsolete models, and incorrect cost updates. After identifying the root cause, I would quantify the financial impact, document the adjustment, and work with operations to prevent recurrence through stronger controls. Be sure to mention reconciling physical and system quantities, purchase receipts, transfers, sales timing, returns, shrink, valuation, obsolete products, cutoff, and coordination with supply chain and store teams. Question 10. Describe how you would build a monthly expense forecast. I would begin with actual year-to-date spending and the approved annual plan, then separate fixed, variable, discretionary, and timing-related costs. For labor, I would model headcount, wage rates, hours, vacancies, and seasonal staffing. For other expenses, I would incorporate contracts, purchase orders, initiatives, inflation, and known one-time items. I would review assumptions with budget owners, produce a monthly phasing, and include risks and opportunities. Each forecast cycle, I would explain variances and refresh the outlook. Focus on establishing the actual baseline, separating fixed and variable costs, incorporating headcount and wage assumptions, contracts, seasonality, initiatives, accruals, timing, risks, and variance explanations. Question 11. What would you include in a Best Buy dashboard for senior management? I would design the dashboard around decisions rather than display every available metric. A senior view might show comparable sales, revenue, gross margin, operating expenses, operating income, inventory turns, digital performance, and free cash flow against prior year, budget, and forecast. I would add category, channel, and region breakdowns where they explain performance. Visuals should highlight material exceptions, with concise commentary identifying the driver, financial impact, owner, and recommended action. Users should be able to drill into supporting detail. In your answer, prioritize concise decision-useful metrics, trend comparisons, budget and forecast variances, category and channel views, inventory indicators, visual clarity, drill-down capability, and clear action-oriented commentary. Question 12. Tell me about a time you found an error in a financial analysis. In a budgeting project, I noticed that one department's expense trend was unusually high compared with its activity levels. I traced the source and found that a recurring vendor charge had been included twice in the forecast. I checked the underlying invoices, corrected the model, quantified the impact, and informed the budget owner before the review meeting. I then added a duplicate check and reconciliation step to the process. The experience reinforced the value of reasonableness checks, not just formula accuracy. Make sure to structure the response using situation, task, action, and result. Explain the validation step, root cause, correction, communication, quantified impact, and preventive control. Question 13. How do you ensure accuracy when working with large datasets in Excel? I start by confirming the source, reporting period, data definitions, and completeness of the extract. I use structured tables, consistent formulas, clear tabs, and separate inputs from calculations and outputs. Control totals help me reconcile the model back to the source, while filters and exception checks identify missing, duplicated, or unusual records. I document assumptions and preserve version history. Before sharing results, I independently review key formulas and test whether the output makes business sense. While answering, discuss source validation, consistent definitions, structured formulas, control totals, reconciliations, version control, exception testing, documentation, and independently reviewing important outputs. Question 14. How would you use SQL or other tools in a financial analyst role? I would use SQL to retrieve and aggregate transactional data by product, store, channel, date, or customer segment, then validate the results against known control totals. For example, I could analyze sales and returns together to understand net demand by category. I would use Excel or Power BI for modeling, visualization, and communication, while keeping transformation logic documented. The objective is not technical complexity. It is producing timely, accurate insight that improves forecasting, pricing, inventory, or expense decisions. Be sure to describe extracting reliable data, joining tables, aggregating by category or channel, validating outputs, automating recurring work, and translating technical analysis into understandable business recommendations. Question 15. How would you assess whether an online order is more profitable than an in-store purchase? I would compare contribution profit rather than sales alone. For each channel, I would include selling price, product cost, promotions, vendor funding, payment fees, labor, shipping, fulfillment, returns, and any relevant store costs. A ship-to-home order may carry higher delivery expense, while store pickup could use existing inventory and labor differently. I would also consider channel attribution and customer lifetime value, but keep the core comparison consistent. The result would show which fulfillment methods create incremental economic value. Focus on revenue and product margin plus fulfillment labor, shipping, delivery costs, store labor, returns, payment fees, customer acquisition, pickup economics, and consistent channel profitability definitions. Question 16. What is the difference between a budget, a forecast, and actual results? A budget is the formal plan established for a period, including expected sales, costs, investments, and profit. A forecast is the best current estimate of what will happen, updated as assumptions change. Actuals are the results recorded in the accounting system. I would compare actuals with both budget and the latest forecast, then separate volume, price, mix, timing, and execution drivers. That analysis helps management understand performance and decide whether corrective action or forecast changes are needed. In your answer, distinguish the budget as an approved plan, the forecast as a current estimate, and actuals as recorded performance. Explain how variance analysis connects all three. Question 17. How would you evaluate a proposed store remodel or technology investment? I would define the investment's incremental benefits, such as higher traffic, conversion, average ticket, gross profit, labor savings, or improved fulfillment. Then I would estimate capital costs, implementation timing, maintenance, training, and any disruption to sales. I would calculate payback, NPV, and IRR using realistic cash flows, with sensitivity cases for sales lift, margin, and cost overruns. I would also identify risks and establish post-launch metrics, comparing actual benefits with the original business case. Make sure to cover incremental sales, margin, labor savings, investment cost, implementation timing, cannibalization, payback, NPV, IRR, sensitivity analysis, operational risks, and post-investment measurement. Question 18. How do you prioritize competing requests from merchandising, operations, and finance leaders? I would clarify the decision, deadline, audience, and level of precision required for each request. I would prioritize work based on financial impact, business urgency, risk, dependencies, and whether the analysis unlocks other decisions. If conflicts remain, I would communicate trade-offs to my manager and stakeholders rather than silently missing deadlines. I would provide a useful preliminary view when appropriate, label assumptions clearly, and then complete deeper analysis. That approach balances responsiveness with analytical credibility. In your answer, discuss clarifying the decision required, assessing urgency and financial impact, identifying dependencies, agreeing on scope, communicating trade-offs, and delivering a reliable answer by the needed deadline. Question 19. Tell me about a time you explained financial information to a non-finance audience. I once presented a cost variance to an operations team that did not work with financial terminology regularly. Instead of leading with accounting categories, I explained that labor hours were running above plan because volume and scheduling assumptions had changed. I used a simple bridge from budget to actual, separated controllable from unavoidable costs, and asked managers to validate the operational drivers. The discussion produced a revised staffing plan and a clearer forecast. I learned that context makes financial analysis actionable. Be sure to demonstrate simplifying technical language, leading with the business implication, using relevant visuals or examples, checking understanding, listening to questions, and ending with a clear decision or action. Question 20. What would you do if a business partner challenged your analysis? I would treat the challenge as an opportunity to test the analysis, not as a personal disagreement. I would ask which assumption or result concerns the stakeholder, then review definitions, source data, timing, and methodology together. If new information changes the conclusion, I would update the analysis and explain why. If the data supports my view, I would show the evidence clearly and acknowledge remaining uncertainty. The goal is a trusted decision, not simply winning an argument. Focus on listening without defensiveness, reconciling definitions and assumptions, reviewing source data, testing alternative explanations, distinguishing facts from judgment, and reaching a documented, evidence-based conclusion. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.